Welcome to this quarter three outlook 2022. We're going to be taking a look at the market and we're going to be analyzing inflation rates, interest rates. We're going to look at yield curves. We're going to look at unemployment, Dixie, and we're going to go ahead and also adjust the S&P 500 for inflation to try to get a better picture of what the market's doing. So my name's Matt. I'm an economics major. I'm here with Vig today. Vig, you want to tell everybody a little about you?
Yeah, I'm Vig. I'm an aerospace engineer here at Purdue University, studying in my junior year. Recently just entered at SPX, which was a really cool experience. But recently I've been a lot more focused on economics and finance along with cryptocurrencies. So yeah, let's get into it.
Sweet, sweet. So we want to talk a little bit about the market. Where are we right now? What is this, the S&P 500?
Yeah, so right now markets aren't looking too good. As you can see from the peak, we've fallen approximately 26%, which is not doing too good. Now, in my opinion, this is a result of macroeconomic factors, one of which is year-over-year inflation. Matt, would you like to tell them a little bit about what's going on with inflation?
All right, so this inflation rate, this is really telling us what the change to the money supply is for a given year. And we measure this through a variety of factors. The Federal Reserve Board of St. Louis actually publishes a lot of factors. I believe that's what this is from. So this is useful to us because during periods of rising inflation, or the periods that directly precede the rise in inflation, generally risk on assets tend to be quite favorable. And in fact, that appetite for risk can in fact predispose us to experience a higher inflation rate. So right now, inflation rates are going up. It's looking like maybe they've peaked, although I think there's a lot of indicators to suggest that there still could be some room for those to go up. If we want to kind of contextualize this interest rate move in the broader scheme, we could go ahead and take a look back at 1980s.
Yeah, totally, Matt. Yes, reiterating what Matt just said, basically inflation's recently peaked. What we think is a peak, obviously we don't know for sure yet, but the Fed is working pretty hard to bring this down. Now, you might be wondering how the Fed is working to bring this down through interest rates. So the Fed primarily uses interest rates to fight off inflation. Inflation, as Matt said, is really bad. So you see the rise in prices. That's what inflation is. So with large economic demand and prosperity, you obviously will get rising prices as the market matures. And this is not necessarily a good thing because as you see today, gas prices are really high. However, wages are still relatively the same as they were a year or 2 years ago. And this adds an extra burden to families, especially here in America. We've seen prices of gasoline go up to extraordinary highs. This is not a good thing. So as you can see here, the Federal Reserve has recently been raising interest rates over time, and today we're at a rate of 3.25%. To get a better understanding of the effect of all of this on the global markets, up here I have pulled up the NASDAQ along with the unemployment rate, as you can see in yellow, and the year-over-year inflation, the year-over-year inflation and the unemployment rate in yellow. So unemployment's in yellow, year-over-year, inflation is in blue, and NASDAQ are the candles. So as you can see here, as inflation has been going up, stock market has been falling. You can also see that unemployment has been going down with time. However, as the Federal Reserve continues to increase interest rates, we're going to see an eventual increase in unemployment. So the unemployment rate will eventually have to come up. And this is what Fed Chair Jerome Powell means by a soft landing. Basically, they need to soften the labor market. Right now, unemployment is extremely low, and we want to see this rate come up. As more and more people become unemployed, the overall aggregate demand comes down in the market, and that'll reduce inflation because there's not as much demand for things in the market. People will eventually start laying off, and prices will eventually resume back to normal levels. Matt, anything to add here?
I think that's it. I mean, we covered a lot of the parts of inflation, interest rates. I think we could get a little bit more into some of the yield curves now.
Yeah, before we go into yield curves, I actually saw an interesting graph. So this shows the total private job openings in blue, and this is a NASDAQ in orange. So they're pretty tightly correlated, as you can see, which is very interesting. So you can see as the total number of jobs go down, the NASDAQ appears to also go down, which is a very interesting thing.
So why do you think that correlation exists?
Well, I think that in any sector of the companies that are inside the NASDAQ, their pricing and their valuations are heavily based on their productivity.
Right.
Right. So when a company is laying off people and reducing their workforce,
Right.
it's a good sign that they're not having a great year or quarter.
Fair.
Right? They're bleeding money. They're trying to make up for it. There's not enough demand for their product.
Okay.
And in turn, they have less revenue. And when you have less revenue, you need less people. So you're going to hire less people, and your total number of job openings within your company, say Apple, will fall from 5,000 to 2,000. And it makes sense that as the total number of job openings falls, that the Nasdaq will additionally fall. But this is something really important to keep your eye on. As a job market falls, you want to watch until there's an inflection point, and that could be the turning point for the markets. Right.
Right.
Cool. Anything else?
I think that's we covered this part of it.
Cool. So what's up next?
Do you wanna do this like in tapes?
Yeah, let's do it.
Okay.
Let's stop it here.
Like I think we can do. I feel like we got it.
We're good.
All right. We'll do Dixie Dollar.
Yep. Dixie, and then the rest of the tabs. You move the recording. Testing. Cool. All right.
Here. Scooch booch.
You float on top. Cool. All right. So this is what you intro into the dollar.
All right. Sounds good. So we're recording.
Yep.
All right. Sweet. So let's do it. So another indicator we can look at is the Dixie. Now the DXY. This is the dollar index, right?
The U.S. dollar currency index. Yep.
U.S. dollar, and it measures the dollar in relationship to other currencies. So
Exactly.
when the Dixie's going up, it means that people would prefer U.S. dollars relative to the basket of other currencies. When it's going down, U.S. dollar is less favorable, less demanded with respect to supply to other currencies. So you can see the general trend if you zoom out. You can see that we're generally in a downward trend where the U.S. has had a lot of inflation. We're also the world reserve currency, so Reed has some really good stuff on this, but we won't get into that. The general trend is down. We are going up a lot, and this is significant. So it's funny because we had a lot of inflation, but the dollar is actually getting stronger relative to other currencies.
Yep.
You want to speak to that, and then also
Yep.
like, what do we make of this?
Yeah, totally. So, I mean, we can go back and look here. I mean, we've been on a parabolic run. It looks like a meme coin right now, to be completely
That's
honest.
fair.
But what's important about the U.S. dollar index, currency index, is it shows where people are putting their assets, right? So during the dot-com bubble, you could see leading up to 2000, right around here, the Dixie was at an all-time high. And then again, you scroll up back to where we are here. You could look in 2020, people were in dollars, and the recent bull run we had before, right up until January. And then you can see we bottomed out and we're back up on a parabolic run. So generally what happens is as the Federal Reserve raises interest rates, the short-term rates go up on fixed income, so
Right.
bonds, to say. So you end up having short-term bonds like 2-year, 3-year, 4-year, whatever. Their rates go up.
Okay.
And that rate is what you get paid back. And it's generally considered risk-free because the United States has never defaulted on a loan repayment. So what tends to happen is during times of high inflation or when the Fed turns off the money printer,
Right.
and raises interest rates, you tend to see a correlation between the dollar currency index and traditional risk-on assets. So to compare, we can add in, let's say it's S&P. I'll add this to a new price scale here. But you could see the general trend. So as the US dollar bottoms, you can see.
Right. So weaker dollar corresponds with higher appetite for risk,
Exactly.
and generally a stronger dollar corresponds to a lower appetite for risk.
Exactly. So right now we're on a parabolic run. People are taking their money out of things like NFTs, a little part of it, but mainly out of the stock market. Definitely out of the crypto market, out of the stock market, and they're moving into cash reserves.
Right.
Or if not cash reserves, they're bringing that money into cash to buy fixed rate or fixed income products. And part of this we can look at is the Hikanashi candles. Now this is a good way to see what the general trend is, and you can see there's a lot of overhangs up here. So it looks like we're just going to continue going for now. But you can see when points for inflection points, you'll tend to see a big shadow on the bottom, and on top, a little wick in the middle. Not wick, but a little body in the middle. Candle.
Yeah, and this candle right here, where it's very short body, very long wicks, it's actually called a doji.
There you go.
Yeah,
Didn't know that. You learn something new every day. Now, another thing we could look into is yield curve inversions. So here I have the US 2-year bond divided by the US 10-year bond. And what's really interesting before I get into the interesting part, let me give you some background. So the US 10-year bond is a bond basically pays you an interest rate
Right. Fair.
every year.
Okay.
And now there's different lengths of these bonds. So there's anything up until 10 years. I'm sure there's higher.
Yeah, there is.
There is. Could probably go up to 30.
Yep.
30 year.
30 year.
That is generally the risk-free
Rate of money.
Yep, there you go.
Right.
Return of risk-free rate of return is generally the 30-year bond. Now, what's really interesting about these bonds is as the Federal Reserve raises interest rates,
Yeah.
short-term rates go up.
Okay.
So, what does that mean exactly when short-term rates go up? That means that the 2-year bond pays you more than a 10-year bond would.
And this is an interesting spot, because it's like when we have shorter term bonds that have higher yields than longer term bonds, that's saying that people are more bearish on the longer term relative to their bullishness in the short term. Okay, so people are like, the market in the future, I'm anticipating, some sort of economic recession, because obviously we're experiencing, pretty good economic growth right now.
I'd say the other way. They're more bullish in the long term, but bearish in the short.
When long-term interest rates decline and short-term interest rates increase.
Well, the long-term rates don't really change. It's the short-term rates that are changing. So as the Federal Reserve increases rates, they're really increasing the rate that banks loan out to each other, right? And part of this also changes quantitative easing and tightening, the selling and buying of bonds. And this buying and selling of bond changes the bond rate, but it changes the short-term rates first,
Right.
rather than the long-term rates. So the 30-year fixed rate is going to be the same as it was 5 years ago, as it is today.
And so the main thing we're measuring is the deviation of the short-term rate from the long-term rate.
Exactly.
Long-term rates don't move.
So what's happening right now is the 2-year rate is paying out a higher rate than the 30-year, because more people are bearish in the short term, so they want to take their cash out of the stock market, and out of the crypto market, and they want to park it in a safe vehicle for 2 years.
Right. Bearish on equities.
On risk on assets.
Right.
Yeah.
And they'd be more
Right.
oriented towards.
So people are obviously taking their money out of risk assets like tech stocks, including cryptocurrencies and whatnot, and they're moving that money and parking it
debt instruments.
into debt instruments
Safe debt instruments.
and commodities. Certain hedges against
Right.
times of high inflation and economic recession. So by parking their money in a 2-year bond, they're getting a higher rate of return for 2 years than they would on a 10-year.
Right.
Which is very weird, because you would expect if you give someone your money for 10 years, they should be paying you a higher yearly return, because it's riskier. Giving your money away for more time is riskier than it is for a short time.
Right.
Right. So what we look at here is, on this chart, we have the 2-year bond rate divided by the 10-year bond rate. Now, if you take a 2-year rate divided by a 10-year rate, you would normally think it's below 1, right? So let's say traditionally a 2-year rate is, these are fake numbers, but let's say 1%.
Right.
Or to make, 1%.
Let's say long-term rate is 2%.
There you go. So 1 divided by 2 is 0.5, so it
which
should
is-
be somewhere down here below this line of 1. However, when the Fed is raising interest rates and the market is not having risk assets, no appetite for them, they just start dumping, people will need to park their money somewhere.
Yeah.
2-year rates it is, because they're paying out a higher interest rate.
Right.
And the reason why is because short-term rates change first,
Then
long-term
long-term.
rates change later. So the 2-year absorbs that shock of the change in rate
Yeah.
quicker than the 10-year does.
And this is a similar dynamic to the MACD, right?
Right.
And another way, just to kind of explain this, but there's another way to look at the 2-year, 10-year differential as literally the difference, so it's just a subtraction. And if we had a subtraction, that period where it goes below 0, that would be the period up here on the graph where you can see we're going above 1. So this is just inverted.
Right. So what we can notice from this graph, and why so many people talk about the yield curve, is truly because if you look at the relationship between the 2-year divided by the 10-year and something like the S&P. So every time the 2-year goes above the 10-year, basically above 1%, we see some sort of recession or pullback in the market. So here, 2-year went above the 10-year. What do we see? way back in 1989, you see a 97% drop in the S&P.
Right.
We go all the way up here to the 2000s, the tech bubble. 2-year went above the 10-year. What do we see? Should be no surprise if I measure this from the correct point. If we look at the peak, no surprise, we fall almost 37%. Once again, we look at the financial crisis or the Great Recession of '08. 2-year went above the 10-year. What did we have? Ooh, we had a fat 50% retracement to the downside.
Right.
Not good. Once again, now we look at 2021. What do we get? Well, remember, blue is a 2-year over 10-year. We're above 1. And so far, it's not looking too good for for the markets. I mean, already we've dropped almost 28%. And the 2-year over 10-year still hasn't come back down below, right? So,
and another thing is this indicator's gotten a lot more popular. You have a lot more retail, and so people are looking to this indicator and then acting on it in anticipation of what the indicator will actually do. So, I mean, a lot of indicators really suck because as soon as they're discovered, the market uses them and then they lose their utility. Because the reason that you would have any like sort of alpha, you beat the average return, is because you know something that people don't.
Right.
And that's exactly this, right?
Right.
We get
I think
information equilibrium.
I think though traditionally, like your real big institutional players that really move the markets, you know, they have economists who have known about this for decades and decades. You know, this isn't anything new. I think retail is a really small percentage, and they can't really move the market. They're just the little fish in the seas.
For the most part.
Yeah.
For the most part.
But it is.
I think
then,
crypto is an exception to that.
I do agree with that.
Yeah.
I think crypto is a big. So you know what? Actually, let's add Bitcoin to this. I think that'd be interesting to see. So if we add Bitcoin US dollar, and if I take an index, let me move this to a new price scale. So we're going to add this, continue left scale, and we're going to make this logarithmic. So if you can see here, I'm going to cover up the the S&P, sorry. Same exact relationship. Obviously, we only until 2017, but there's no data to look at. But as of right now, you can see 2 years above the 10-year. It looks like we're on our way down again.
Right.
Now, I guess you could say there's a little tiny peak here, and we did see a downfall, but it's not a mature market yet. But that is a really good point. I think something else really interesting to look at in terms of the macro would be Bitcoin's chart against the money supply. So this is basically an inflation-adjusted
Bitcoin.
Yeah, inflation-adjusted Bitcoin.
Right. The first time I saw this was Ben Cowan.
Yeah.
Yeah.
Actually, shout out to Ben.
Yeah, Ben's great.
Ben, I would highly recommend you all go follow Into the Cryptoverse at
Yeah.
Ben Cowan. He does a really good job at pointing out a lot of this. Both Matt and I have learned a lot from him, so definitely highly recommend you go check him out.
He's the OG in the space.
Definitely the OG, definitely knows what he's talking about, highly recommend it. If you really take into account the inflation-adjusted returns, basically how much money is being put into the economy, Bitcoin hasn't moved since 2019. We've just gone sideways, which is very interesting. This seems to be a historic bottom, which holds a ton of support. So this could be a good indication that we are at the bottom here. If I was to draw a trend line here, somewhere over here. I mean, this could be a good indicator that we're at the bottom. Like, you know, we wicked here way back in March 2020. We found good support here back in 2019. We're finding really good support back again in current day.
Right.
However, one thing to note is we did fall down, way down back here in COVID, and got some good support here. So I'd say if we break down, I'd say the risk you have to look out for is a move of almost 42%.
Right.
Given that inflation, that the M1 money supply stays constant, which is a pretty big fall for Bitcoin. That would take it down to what, almost
Like we'd be looking maybe like 13.
10, 11K, right? A 50%. Well, this is a 42%.
Yeah,
So
like-
I'd say, yeah, you're right. About 12, 13%, 13K.
Okay,
Yeah.
something like that.
Which could be surprising. I mean, if we look at the Bitcoin chart right now,
Yeah, let's
yeah,
see
so
that. What would a 42% drop look like?
42% drop from here would be pretty brutal. That would put us down at almost, what, 11K?
Wow.
Yeah. Now, I mean, another good thing to look at would be the S&P divided by its money supply. As you can see, we've put in historic bottoms around what is it? Let's call it 0.14.
0.14 level.
Yeah,
Yeah.
which would correspond to a price of, let's see, what price would that correspond to? That would mean the S&P needs to fall another
15 to
16%.
which would also put us on par for those 50% corrections that we've historically seen, because we have a 35% correction right now.
Right. So if I pull up that S&P 500 here, a 16% fall would put us where? That would put us, oh Lord, that would put us at about $3,000. That would be a pretty nasty fall, but you would need something big to break in the financial industry. Maybe Credit Suisse going under. That's a whole discussion for another day. But yeah, I think importantly, just as a conclusion to wrap it up, like looking at Bitcoin today, obviously you have your logarithmic, your log bands, which have done a great job so far.
Like it's not a bad time to buy right now. I think that's kind of an important point. It's like it's not a bad time to buy in the grand scheme of things.
Right.
Especially if we adjust for inflation. Still, like, it's not a bad time to buy. Things they definitely could get worse. Right. We're not at a point like we saw with COVID, where Bitcoin goes down to 4K and it's just like,
right.
This is a clear buy.
Totally agree.
There's still a bit of ambiguity in the market, I would say.
I would definitely say, like, if you're in a dollar cost average, like now's good. Like 19K Bitcoin, like from our all-time high.
In the grand scheme of things, yeah.
Yeah, from our all-time high, like we're looking at what? A 71% correction. If we look historically at the markets, we're looking at the Bitcoin, we're looking at a 90% fall.
Right.
We're looking at a 85% fall, and then we're looking at what? A 80% fall again.
Mm-hmm.
So obviously with diminishing returns, you can also see diminishing losses. So I mean, if last fall was what, 80% about?
Right.
80%.
And
so
we would also expect the rate at which we see diminishing losses to sort of maybe like not be as dramatic as I think a lot of people thought. So we could still see like we saw what, 85% 2017.
right.
Then we may see 79% or like 82%. Like those would definitely not be out of the cards, and we could extend past an 80% correction. It might just be that the average returns decrease, because if we have diminishing returns, we're going to have diminishing moves in both directions. So the probability that we exceed those boundaries, the difference from the last price move, increases as time goes on.
Right.
Because if we're in tighter and tighter bounds, then it's like the probability that we hit the same percentage fall, or the same percentage rise as we did last time, starts to increase. So it's like now we're starting to.
I think one important thing to add there though is Bitcoin has never been through a period of high inflation, right?
That is true, right?
So that's something to account for. The whole market structure could change, right? We have a lot of things. So we have new institutional interest. I'm not going to comment on whether it's there yet or not. We have regulations. I'm not going to comment if it's there or not. But one thing we can say is that Bitcoin has not been through a period of high inflation yet. So traditionally, we've wicked down. If we've broken the 200, we've wicked down to the 300. Don't ignore this dubiously drawn a line, as Ben Cowan would say.
Yeah.
But we've traditionally wicked down to the 200 right here, hold that support. Or if we break the 200, we wick down to the 300. Right now, we've broken through the 100, the 200, and we're down at the 300, and we're below the log regression, right? The only other times that we've broken through the log regressions, we've fallen almost, 26% below, right?
Yeah.
Here, way back, we fell below, we fell 12%, so 12, 26. Right now, we don't know what will happen. As of right now, we're already 8% below, but it's also important to note that we are at this critical point of historic support, the 300-week moving average, right? So we haven't yet touched it, which is actually very interesting. We've almost looked down to it, but we still have not touched it, which is something to note. The 300-week, we've held historic support. Throughout time, you can see all the wicks down to it. Now we've never actually touched it, which is very interesting to me.
Really, even in
yeah, it wasn't a touch. Look, barely made it.
Well, what about 2000?
2% away.
What about 2017?
Didn't even make it. Held support at 200.
What about 2010?
Yeah, I guess if you want to draw it out, I don't think that's really mathematically sound though. But with what we have right now, this could either be.
It's a strong support.
Yeah,
that's the point.
Me personally, I don't think we're at the bottom. Traditional markets bottom when inflation peaks, right? You could see it if we go back in history. Let me delete these. Sorry, guys. Traditional markets tend to bottom when inflation peaks.
Yeah.
That's what we traditionally see happen. As you can see here,
Now,
2008,
and that's
inflation peaks.
That's the trend, but of
Bottom.
course there is exceptions.
There are exceptions.
Benjamin Cowan has a great video on this
He
particular
definitely
topic, and he goes through and does like a much more in-depth analysis of.
Right. Yeah, I mean, here again, you could see it 1990, inflation peaked, bottom.
Right.
All right. If we look again, we could see big recession 2008, inflation peak, markets bottom. Now here, we don't know if this is a peak yet. It could be a fake out, move down, back up to the upside, but even if it was, clearly the markets didn't feel like bottoming there.
Yeah.
Which is why I don't think it's over yet. I don't think we're done yet. I think inflation is too high. It's not coming down as quick as the Fed would like. And more concerning to me is that the unemployment rate is still so low. This needs to come up, to have a true softening of the labor market. But yeah, overall, I think we did a really good job at going in depth into the macroeconomics and how they affect risk assets.
Right. Hopefully, like your picture of the macro outlook is just a little bit more crisp now.
Right. Our main goal is to take everything that we've learned throughout this process and really give it to everyone. Show people. You don't need an economics degree, even though you do have one. You could be an engineer and figure this stuff out too.
Yeah.
You don't even need a college degree to figure this stuff out.
Yeah.
I think basic economics are important for everyone to know, and their effects on the markets are even more important to know because that's where your money is at the end of the day.
Yeah, look, it's all just about understanding, and the best way to kind of understand something is just to research it a lot and just to play around with the ideas. The conceptual model that I have for looking at the market is that you'll never understand with perfect certainty what is going to happen with the market. You can never say, with perfect certainty, we're going to go up, we're going to go down. What you can do is you can paint a picture, and you can increase the resolution of that picture by looking at more factors and understanding those factors better than other people. And if you want to do the trading game, trading is a zero-sum game, basically. Investing is positive sum, but trading, you're against someone else.
Investing, all markets are a zero-sum game. There's always a winner, and there's always a loser.
not in all markets, because equities, the whole point, right? We'll call it passive income, but different thing. But
well, even with equities, I mean, you give your money to a fund manager, right? That money's coming from somewhere.
But there is fundamental economic value that comes from increasing the productivity, or the efficiency of a market, and then companies can increase earnings.
Right, because you're investing.
When you invest in companies, your gain, the real gain, is from either the dividend or from the stock buyback.
Right.
And I think the stock buyback might be maybe not the best way to increase, to incentivize people to buy a stock. You're just reducing supply. I think a more organic way would be to pay dividends, to really share your profits with your shareholders, because that was the purpose.
Yeah, so I think that really wraps up everything we wanted to tell you guys about macro and
Definitely.
how macroeconomics really do play a huge role in global markets,
Right? Yeah.
including cryptocurrencies.
They set the
No
tone for
difference.
what's really possible.
Right. The term "never fight the Fed" is a thing for a reason. Right. I think everyone should know that by now. But more importantly, this video was aimed at bringing people who weren't too familiar with macroeconomics and giving them a basic understanding of the important things you need to know and how they affect your money that's invested. Because at the end of the day, it's important for you to understand how policy decisions are affecting your money.
Exactly. And the more pieces of the puzzle you understand, the more indicators you understand, the more you understand the properties of those indicators, what they mean, the more you can understand how to use them, the more you understand about the market.
Right.
Better decisions you can make. More information and better understanding never led to worse decisions.
Right. Awesome. Well, thank you guys for watching. Hope you guys learned something new. If you did, make sure to toss it down in the comments and give us a thumbs up. Make sure to subscribe. Thank you guys so much. And